Welcome to our show. It's nice to see you.
Thank you, Scott. Nice to be here.
Yeah, I mean,
yes,
between currency, well, I was going to say between currency issues and IT spend worries, it's kind of tough to get all bulled up about tech.
I think that's a fair sort of assessment. I mean, we've had inflation, currency, interest rates, of course. So, but I think what is front and center of mind for us is actually the capital cycle playing out in tech and several areas adjacent to tech. And you've seen this heavily in the private market side where, typical VC funding in this environment has been, about $200 billion a year or so for the last decade, except in the last few years it stepped up to $600 billion or so. And so now what we're seeing is this giant sucking sound of companies retrenching both on the private side and then clearly the spillover on the public side, where there's this sudden focus on profitability. And what that does is a lot of uneconomic spend gets cut, and then you get to sort of see who's been sort of swimming naked. Now, I think that is starting to get pretty well recognized by the market, but to some extent, that was conflated with ideas around the macro regime change. So I think we think of this as really just a good old-fashioned capital cycle playing out in tech. In fact, in this regard, yeah, go on.
Well, we set this up sort of as we say tech, but I look at the stocks you like. I look at these new ETFs that you guys have set up. And yes, there's the NVIDIAs or the analog devices that are in there, but I've got T-Mobile, Marriott, Nike. We're talking far beyond your traditional garden variety technology companies.
Yeah, I think that's right. I mean, investing, you referenced whether it's the energy transition fund that we've launched or launched the Disruptors Fund in an ETF format or the Connected Consumer Fund. These are all extensions of our franchises in the space. I think what we wanted to do as a firm was to sort of bring the idea that tech investing does not really just equate to meme-like investing, right? For the last some years, investing in innovative or disruption-oriented companies had gotten the status of just investing in memes. And when you look at companies like T-Mobile, when you look at companies like even Floor & Decor or take an Ulta, which is a very large brick-and-mortar operation, 95% of Ulta's customers are digitally native. And what happens is beauty shopping is hyper-personalized. And so in this context, when you grow a customer base from 11 million subs to 40 million and actually generate free cash flow, you create economic value and not just build a castle in anticipation of people coming there.
I notice some of the other themes or areas that you like, and I'm surprised to see this, frankly. I mean, why would I want to invest in the industrial economy right now when economic fears are so pervasive? The rails, I really want to buy the rails now?
You're right. I mean, I think, when we think about the rails or even a company like Analog Devices, Analog Devices is a semiconductor company, but really a company that is geared into the industrial economy, as different from a company that's geared into the consumer economy. I would say the industrial economy on a relative basis has been doing okay, if not for now the fears of this recession. If you look at this again, the last 10 years, industrial production growth lagged GDP growth by 200 basis points or so per year. And in those 10, 15 years, you've really not seen supply growth come up. So coming out of what may be a mild, a heavy sort of recession, I think you're going to have a booming industrial economy, and you want to be geared into companies that provide the picks and shovels, or even if it's an Analog Devices that provides battery management systems for electric vehicles, which is going to be a very, very important driver of decarbonization.